Recording in progress.
Good afternoon. Good afternoon. It's Monday, the 29th of April. Welcome to another edition of Monday Market Picks. My name is Thilan Vikramasinghe. I'm the head of research for Maybank Securities in Singapore. So thank you so much for joining us. If you haven't downloaded this week's newsletter, it's not too late. You can do that by just scanning the QR code that's on the screen right now. What a week last week it was for the markets. We saw some very strong results from Microsoft and a lot of other AI tethered names. That shows that the theme is very much alive and kicking. It's also propelling the US markets forward. We also saw some central government support, at least some positive news flow coming from China. That's also helping the North Asian markets in Hong Kong as well as China. With some record foreign buying there. And the KLCI in Malaysia is at a 52-week high. So a lot of green out there. And I think That's going to wash through to the Singapore markets as well. We are in the middle of Singapore's results season, and the S-REITs have really gotten off the gate here. We've got Krishna standing by to discuss what he's seeing so far right now. We've also got the three big banks reporting this week, starting with DBS on Thursday. I'm going to give an update on what to expect and how to position for those results for the first quarter. We've got inflation coming down in Singapore a little bit faster than expected. So what does that mean in terms of MAS policy? We've got our economist Brian also online who's going to discuss that. And we've got Nick, the chart guy, back, and he's going to be showing a couple of charts with some great ideas a bit later on. And we also had some very interesting announcement from Singtel that's kind of knocked the share price down a bit. We've got Husseini to explain what the key takeaways are. So without further ado, let's move to market movers. As I said, we've seen most markets in the green last week. The S&P up about 1%, largely driven by Microsoft and a few of the other AI theme names. And that's really also driving the NASDAQ as well, which was up 2%. In China, the Hong Kong index was up 2%, largely as there was pronouncements of the central government will support more capital raising and listing on the Hong Kong exchange. So that's quite positive as well. Shanghai Composite also up 1.2%. Within Southeast Asia, STI was fairly flat, down about 0.2%, but the KLCI quite strong, up about 0.4%, largely driven by positive news flow in terms of a lot of the reform action that is happening there. So quite a few things to watch out for this week as well. And certainly not least of that is the S-REITs, which have started to release their first quarter results. We've got Krishna, who covers REITs for us, on the line. Krishna, we've had several of the REITs reporting. We had FCT, we had SCLAS, we've got ESR Logos. What are your initial observations so far?
Thank you, Thilan, and thank you for having me on the show. So initially, I think not much surprise either on the upside or downside from this set of results/business updates. For the names that have reported, the distribution per unit as well as the net asset values, I think there is a mixed trend that we are seeing in distribution. Slight increase probably on a sequential basis. Some still reporting declines in their DPU. We are seeing NAVs to be down from the earlier numbers. So I think on those headline numbers, a mixed set of results. In terms of operational side of things, we are seeing some sort of softness in what was earlier quite a robust set of operations. We are seeing occupancy, which continues to be weak for the overseas assets. And now even for some of the Singapore offices and industrial assets, we are seeing some decline in occupancy. However, on the rent reversion on the other side continues to be extremely strong and robust. So that kind of is carrying out the net property income for these REITs higher, which unfortunately is getting offset by the higher borrowing cost.
Got it. Now, I remember fourth quarter, we did see quite a bit of downward adjustments to earnings and DPUs for the REITs. Is that the sort of trend that you're seeing this quarter as well, or have things stabilized a bit?
So I think it is, again, very REIT specific. In some REITs, we have lowered our estimates by close to 10%. But I will say that the broad decline to DPU estimates and NAV estimates, we are seeing some stabilization there, and that's because that most of the repricing of the debt has happened. I will not say that 100% of the debt has been repriced, but the bulk of the adjustment has happened. So what we can see is from the interest coverage ratio for these REITs, those are either stable or they are going down, but at a slower pace. So all depends for this sector on how the rates kind of play out for rest of the year. Obviously, fourth quarter, everybody knows that we had a sharp rally because of the expected 5 to 6 rate cuts, which have kind of now moderated down. I think for our house view is 2 to 3 rate cuts starting from third quarter. So depending on how that whole trajectory goes, the sector is likely to perform according to that direction.
So exactly. So that's something I kind of want to touch on. You rightly said we had like a much more bullish view on rate cuts at the beginning of the year. Now it's kind of gone down to 2 rates to no rate cuts. And just in the last 2 months. So hold off on the REITs. So what do you think investors should be doing right now?
So I think our view has not changed right from the, I think, early last year when I started taking coverage of this sector, that I think this is an important sector within the Singapore context. Deposits are growing and they do give dividends. So you cannot have your skin completely off the game, but you have to be selective. So my view is that if you are going to trade, then the high yield sort of low price to book names do give you an opportunity. But you have to have them with a trading view. And I think trading small always helps, because even if you lose, then you do not lose much of the money, but you have to trade frequently. If you want to have a core position, then I will stick with the large liquid names. And I have mentioned quite some time that some of the topics on them are like names such as CICT, Capital Ascendus, Fraser Centerpoint Trust. So those are the names that I will stick with. And for the high yielders, low price to book, I will be trading them off and on.
Got it. So be selective as we go into the rest of the quarter. Thanks, Krishna, for joining us on that. And when you talk about interest rates, you got REITs, and on the other side of the coin are the banks, and the Sing banks start reporting this week. DBS will be out on the 2nd of May, UOB on the 8th of May, and OCBC on the 10th of May. So let me give you some color on how I'm thinking the banking sector will perform for the first quarter. We are expecting earnings momentum to actually be fairly flat for the sector. From a combination of peaking net interest income, as well as fairly slow growth in the non-interest income side. We are expecting funding costs to be chipping away at the net interest margins, while loan growth also will be fairly tepid, largely from fairly slow growth in North Asia, in Hong Kong and China, and also the strong Sing dollar kind of translating away some of the growth that we may have seen in some of the ASEAN countries. Plus, a lot of customers, especially the corporates, are kind of staying sidelined because of the high interest rates as well. One of the areas that we are really closely watching is wealth management. So this has the potential to turn around at some point, given the massive amounts of inflows Singapore banks have enjoyed over the past couple of years. And we are watching to see where the clients are starting to put some of their AUM to work rather than keeping them in fixed deposit. Right now, we think there will be some of that happening, but not a lot. I think clients are still going to be a little bit sidelined. The other area that we'll be watching very closely will be management guidance. Remember, Sing Bank's managements do provide some very strong guidance in terms of how they expect overall earnings and overall loans and margins will fare out for the year. Remember back in February when they provided their first sort of guidance for 2024, the expectations were for 4 to 5 rate cuts. Now the rate cut scenario has changed significantly to two cuts to no cuts. So in that sort of scenario, there is potential for managements of the Sing banks to upgrade their outlook in terms of earnings. So that's something to watch out for. And obviously, upgraded earnings is something we like because that provides more certainty in terms of dividends. Finally, things like asset quality in terms of NPLs, we're not expecting any big changes this quarter. In fact, we probably expect credit charges, which is the provisions the banks take on their P&L, to actually come off during this quarter. In terms of banks that can surprise on the first quarter for earnings, we think DBS and OCBC has the highest chance for that from better trading income as well as lower provisioning. We also saw Great Eastern's results that came out earlier today. which shows that, earnings have grown there. So that's actually a positive for OCBC. UOB, on the other hand, might see a little bit of pressure on their margins, just like what they saw in the fourth quarter of last year. So overall, for the banks, we're keeping our view that it's neutral, but we are leaning a little bit more towards a positive when given the higher for longer sort of interest rate environment. Our top pick remains DBS, followed by OCBC and then UOB. So do watch out for our results notes coming through on the banks, over the next few days. You can see recommend our OCBC is not a buy, it's a hold at the moment. You can see those recommendations on screen right now. UOB is also a hold. Okay, so let's move on to speaking about banks and REITs. Let's move on to central bank policy. Again, still down to a lot of interest rates, and we've got Brian, our economist, on the line. Brian, welcome to the show. Singapore reported inflation data for March, which fell more than expected, despite having Taylor Swift in town. What are some of the reasons for falling inflation, and will it keep falling? And what do you think the MAS will do?
Hi, Tilan. Thanks for having me on the show. Yeah, indeed. So we had core inflation cooling to 3.1% from February's 7-month high of 3.6%, while headline inflation slowed to 2.7%, which was actually the lowest print since September of 2021. If you break down the drivers, I think food and travel services were the main drivers of the decline in core inflation, as essentially the bump up in demand during the festive Lunar New Year period dissipated. And I think the slowdown in headline inflation was also attributed to a decline in private transport costs, in addition to the factors I described above, as we have cooling COE premiums. I think looking ahead, there are forces driving down inflation this year. External pressures for core inflation are easing off. Imported inflation is being dampened by the strong exchange rate, cooling global prices for most food commodities, and also goods disinflation from China. And headline inflation will be falling and probably diverging from core inflation given the easing COE prices and private transport costs. Nonetheless, we caution that domestic cost pressures remain elevated, which is contributing to only inflation still being sticky and slow to decline. Businesses may continue passing on higher cost to consumer prices. And I think the 7% hike in water prices in April does not actually help things here. So I think all in, our assessment is for core inflation to drift down gradually towards 2.5% by the fourth quarter. And we think this should open the door for MAS to ease policy at the October meeting at the earliest.
Okay, so October is the key sort of month to watch out for easing. Now, Brian, while I have you on the line, we saw industrial production also come off in March, well below expectations, in fact. Do you think, we've had this story of electronic manufacturing recovering for most of the year. Is that in jeopardy? Will the weak manufacturing figure lead the Singapore government to actually revise down their GDP forecasts?
Well, yeah. So I think we saw industrial production falling by 9% year on year in March, and a large part of this was driven by electronics. Electronics output actually plunged by double digits, 11% year on year in March, and this was mainly due to weakness in semiconductors. So I think if you break down the drivers, it's interesting that Singapore's electronics recovery has actually been lagging behind the pickup seen in other tech exporters in the region. We think Singapore's production structure may not be as leveraged to the ongoing boom in advanced chips for AI servers as compared to peers like Taiwan and South Korea. In contrast, Singapore's semiconductor ecosystem is mainly built around mature nodes. Thus, the Republic may be more exposed to the slowdown in demand for, automotive as well as industrial chips. Moreover, I think we have China urging its EV makers to buy local auto chips instead of foreign-made chips, and this may be dampening its import demand. Nonetheless, I think we are still optimistic on Singapore's manufacturing recovery in the months ahead. we think that the electronic cycle upturn will broaden beyond AI servers. And in particular, I think Singapore should benefit from the recovery in memory chips as an important producer in this area. I think demand could be supported by new replacement cycles for smartphones and PCs, and also growing demand for generative AI applications, for consumer electronics. But I think given this weak March manufacturing figure, I think it's inevitable that there will be a downward revision in the first quarter GDP growth. We are expecting GDP to come in around 2.2% as compared to 2.7% in the flash estimate.
Got it. Thanks, Brian. In fact, there's a very interesting article on the Straits Times that is actually featured in our newsletter, talking about Singapore chip makers see growth wave amid generative AI boom. So that's something to read and see the multi-year sort of growth story that AI can bring to Singapore as well. Thanks, Brian, for joining us. With that, we've got Nick, the chart guy. He's online, and we've got some. He's got some great ideas that go really well with the chip and the tech manufacturing story. So, Nick, what have you got for us?
Thank you, Dylan, for having me today. Good afternoon, everyone. So for this week, we have two stocks. The first one is Aztec Global. The stock has been highlighted in our regional strategy almanac back in 26 February. As per our previous report, the stock has gained about 15.3%, but yet to hit our first target. Our first target is actually at 1.02. It was peaked at a high at 1.01. We missed by 1 bit. But regardless, the uptrend still pretty much in play despite the subsequent minor correction. As you can see, last week the stock is actually rebounding off the yellow line color, which is actually the 100-day moving average, and of course another support level within at 38.2 Fibonacci level. So the new high-low structure was formed for the stock, and I do think there's a room for further upside given the uptrend is pretty much intact. If you look on the RSI, is also improving back into the 50-point mark. And if you look another reading on the mssg, it actually start to converge and could actually flash a new buy signal soon. But because of that, I think in terms of the risk ratio, we think a current level is quite attractive for reaccumulation, particularly when we revise our stop loss slightly higher. Your risk is about 7.5% downside risk with the potential reward up to 17%. So we actually reiterate our technical buy with a new I think we're introducing a new high target at 1.1 Sing dollar, and support remain the same. Support is higher at 86.5 cents. So that is actually the first one. The second stock will be
Let's change the slide.
Franken Group. So what I like about stock, if you look since the high on March, the stock is actually on the correction. But the correction has ended, particularly when the stock is creating some sort of reversal signal last week. Now, if you look slightly on the left, there is a high on February, right within at 1.46 Sing dollar. So those actually the previous resistance now turning into a support level. So those rebound as per last Friday has showcased that the stock is actually forming a hammer pattern. So this hammer pattern is actually what we call that a reversal pattern. Now, if you combine two of the candle, the previous two of the candle on the last Thursday, on last Friday, you get another pattern of harami. Harami is also a bullish pattern. And if you look on the overall trend structure, is pretty much what we call that positive. Now, while MACD yet to hit what we call that flash any buy signal, but I like the reading on RSI. If you look on RSI, the momentum, the RSI has kept testing the oversold territory at least number of times for the past few weeks, but it did not go through inside the oversold territory. That means there's a plenty of the interest coming in, lurking within those particular level, which is actually sit at 1.45. So with that in mind, the reversal also occur within 61-point Fibonacci level, and we think there's a plenty of the confluence signal. Because of that, we think it's worth to look for the stock at the current level, particularly when you risk to reward ratio is quite decent at 1 to 2.7, which means you risk about 6 to 7% with a potential upside of 16%. So okay, that's two from me for this week. Hopefully, this going to give trading well and continue the uptrend.
Thanks, Nick. That was really helpful. So please do have a read through his notes on our newsletter today. Now we're running short of time, but we're going to have Hussaini, who's online. Singtel's announced some major impairments today, as well as a regional network sharing deal between Optus and TPG. The stock hasn't really taken that quite well. So, Hussaini, can you please tell us what this Optus TPG network sharing agreement is?
Yeah, sure. Thanks, Thilan, for having me. It's a multi-operator core network agreement. Simply put, TPG and Optus are going to operate only one singular network going forward in the regional Australia rather than two networks. Okay. Now, this means savings on the OPEX and CAPEX side. Okay. Theoretically, it should halve the cost of running a network by 50%. Okay. Now, as Optus has been ahead of on the rollout compared to TPG, they are going to get a net inflow of 900 million Aussie dollars from TPG for the next 11 years for the duration of the contract or duration of the agreement. So we see this to be free cash flow as well as ROIC positive. Now, Singtel management just hosted a call and they noted that they expect Optus capex to go down to mid-teens from 19% currently. So essentially, network OPEX and capex savings in our view, and we see it in a positive light.
Right. So if it's so positive, why is the stock not reacting negatively?
Yeah, so there was also an announcement of impairment, non-cash impairment of $3.1 billion. Of that, majority of it was 80-90% of it was linked to goodwill impairment, and around 500 million linked to asset impairment in the enterprise business of Optus. Okay. Now the remaining goodwill impairment is because of them imputing higher cost of capital as well as higher WACC in their future cash flows, leading to lower present value and the goodwill impairment. But investors are a bit spooked that is Singtel factoring a lower growth going forward, which management clarified it is not the case. They do see slower growth in the enterprise business of Optus, but that is a very small component of Optus. The consumer business, which is 80-90% of the Optus business, they don't see any impact. But nevertheless, there was a goodwill impairment, which kind of concerned the investors. Now, management also clarified that these are one-off charges and doesn't impact their dividends. So no risk on dividends. We see around 5 to 6% forward yield for Singtel. No risk to that. And in our view, this correction is a buying opportunity in the stock.
Got it. So it's mostly non-cash and no impact to dividend. Thanks for that, Hussaini. We're short of time, so we're going to jump into upcoming events. We got still in the middle of results season, so quite a few REITs that are still coming out in the next few days. So quite a lot of them reporting today and tomorrow. We got Parkway Life on the 30th, CDL Hospitality Trust also on the 30th, and then DBS on the 2nd of May. In terms of events, we've got a few big events that are happening. A couple of invitation-only events for SM Prime, as well as current market dynamics in TV and connected TV advertising. That's, I think, with our partners in the US, Wedbush Securities. So do speak to our salespeople if you'd like to join them. And also, we've got a very exclusive corporate access event with Paragon REIT, which is on the 8th of May. You can sign up for that using the link that's on your screen. With that, unfortunately, we've run out of time. As always, thank you so much for taking time on Monday to join us. We hope to see you back next Monday. Have a profitable trading week. Thank you.